Hi, and welcome to the third episode of Slot Leader. I'm your host, Umet Saidov, and in this episode, we'll be focusing on misconceptions that surround digital assets. In episode number 2, last week, we had Colin Edwards, who is the quantitative strategist at IOHK, talk about digital assets and digital asset markets. And one of the key takeaways there for me was the fact that a lot of people still do not understand this space, which paves the way for a lot of misconceptions out there in the mainstream consciousness. As a podcast that is trying to bridge the knowledge gap between the traditional finance and the blockchain finance, it is time for us to address some of the major misconceptions that surround digital assets. So stay tuned, and I hope you find this information useful. The blockchain industry last week saw two major news events that are worth mentioning, and both of them involve cryptocurrency exchanges. So the first one is the KuCoin, which is a Singapore-based cryptocurrency exchange. It got hacked. It looks like the perpetrators broke in and made away with $281 million worth of cryptocurrencies. Apparently, they took Bitcoin, Ethereum, and some ERC20 tokens. But the latest reports are showing that the cryptocurrency exchange have recovered apparently $202 million of these lost, cryptocurrency digital assets. So that's kind of a good news in that respect, but it still goes to show that the centralized exchanges are very vulnerable. So if you are holding your digital assets in centralized exchanges, you always risk this kind of eventualities. The second news involves another cryptocurrency exchange called BitMEX. This past week in the United States, CFTC, which is the Commodities Futures and Exchange Commission, charged the cryptocurrency exchange with the operating an unregistered trading platform and violating anti-money laundering laws and regulations. As a result of this event, the market started going down, and it recovered a little bit, but it looks like this trading platform lost around $475 million worth of Bitcoin during a short period of time when people were trying to probably get their digital assets out of this platform. We'll be monitoring this news as it has some implications about what kind of actors can exist in this space and what they can or cannot do. It'll be interesting to watch what will happen and what will unfold. One of the interesting and significant events that took place in Cardano's ecosystem is the announcement by Singularity Net to move their token onto Cardano. In his interview with Charles Hoskinson, Ben Goertzel, who is the founder, I believe, of Singularity Net, voiced his concerns about what's happening with Ethereum, more specifically Ethereum becoming very slow and expensive, and as an alternative to that platform, he's considering moving, or he's decided already to move part or all of the tokens into the Cardano ecosystem. Now, I think the mechanics here work in such a way that the market will decide which portion of AGI tokens will live on Cardano or or Ethereum. But I think his intention is to make his platform, which is Singularity Net platform, interoperable with different sort of networks. So we'll see how this develops, but it's a great first step. I think it's a great piece of news for the Cardano community as we are embarking a period when we will have Goguen around the corner. One of the other things that is worth mentioning is that in his recent AMA, Charles Hoskinson mentioned that close to 90 teams are thinking about joining Cardano, and that's another piece of good news and shows how popular or in demand Cardano and Cardano's infrastructure could be in the coming weeks to months. And that bodes really well for the ecosystem in the long run. And the third thing that happened in the ecosystem is the Catalyst project. The projects that have been submitted have been now transitioned into a second stage, which is the review stage, and they will be in that review stage for about 2 weeks. So we will see how things will go there too. If you haven't checked out the Catalyst website, please do so if you're interested, and see what kind of projects you see in the Catalyst website, and support the ones that you believe in. So the cryptocurrency markets demonstrated some interesting dynamics this past week. The most notable of them is the reaction to the BitMEX enforcement action by CFTC. On October 1st, the news broke at around 1554 UTC that about this enforcement action, and the prices changed quite dramatically at that point. In this chart, which shows the ADA to USDT, you can clearly see the sell-off here. It started on October 1st, and it started going down significantly, and bottomed out on October 2nd at 4 o'clock in the morning in the Eastern Standard Time. Things started getting better. I think, the market and the people who trade probably realized that it's not something widespread. Maybe the extent of the uncertainty was the gap was closed in that regard, and the price started recovering almost back to its normal levels pre sell-off. So that was the development. It kind of goes to show that the market is still moved by a lot by what's happening in the social media, or in the media in general. And I believe this is the work of algorithms doing their job in terms of sentiment analysis. So the fundamentals of the technology did not change in that short time period. In nothing significant that could impair the value of this network, was identified. So if anything, that probably was a good buying opportunity that I unfortunately missed. The misconception that it's blockchain, not Bitcoin, stems from the fact that firms or individuals or the CEOs do not understand how and why blockchain exists in the first place. I mean, if you think about the underlying conditions under which blockchain was created you will see that it just makes no sense to have a blockchain within a company. It just, you're much faster just having everything in an immutable database and have different access points for it for different individuals. Blockchain itself, as a system of record keeping, is built for an open environment where everything could be compromised in a very hostile way. And in that environment, you need a unit, an economic unit of value to incentivize the miners in this case to keep the chain running and secure the chain. It's a classical example of the invisible hand. If you've read the Adam Smith, The Wealth of Nations, the main sort of idea there is that everybody working for his own benefit actually creates the wealth for the entire nation. It basically describes a system of incentives in which people working for their own interest increase the total pie, so to say. So it's the same thing in Bitcoin, in the sense that miners are only interested in getting those Bitcoins, which have economic value, and by solving those puzzles, they are securing the network, and that's the only way the blockchain works in the proof of work system. Now we have other systems right now, namely proof of stake, where the economic incentive is there, but you have to have coins to participate, rather than buying expensive equipment that could become obsolete down the road. So as we iterate through technology, the role of token changes. In the third generation, token not only represents something of value that you earn by mining, but it also represents something that will give you the right to vote. For instance, in Cardano, the token is a way for stakeholders to express their vote on certain issues. In Catalyst, we see that happening in real time. So token itself becomes this hybrid instrument that has economic value on one side, because it's the only, for now, the only thing that is accepted in Cardano ecosystem as a fuel. You can spend it to move value, and in the future, near future, you will be able to spend it in order to fund and fuel smart contracts. So that's the second way of spending it, or second way it could serve some sort of value, serve a purpose. And then there's a governance aspect to it, right? So in Cardano, the governments will be on chain, sort of, and you will be able to vote on issues with your ADA. So that becomes a multi-dimensional sort of issue there. And it's no longer blockchain is serving to secure the chain, and Bitcoin is the currency of the chain, and that's the only thing that's being emitted, and there's nothing else that token represents except for being sort of a currency. So we are moving in a direction where tokens are something completely new. It's a hybrid, as I say, instrument that could represent currency, if you think about it that way. It could represent fuel, commodity, or utility, because it's used within an ecosystem to fuel a smart contract. Or it could represent a governance instrument, where your token could be used to decide the direction of a chain. But as these platforms start eating the real world, the value of these tokens, especially if they are capped in supply, will grow significantly in some cases, because there's a finite supply. You can't just print it out of thin air. There's a supply schedule, and if the demand outstrips it, then the price will adjust accordingly. So yeah, one of the useful ways would be to think about it as a currency of a nation also, right? If you go, okay, US dollar is an exception, of course. It's accepted anywhere you want to go. But if you go to a country X, let's say you go to Russia, you take out your US dollar and you try to pay. They don't know. First of all, they don't know the exchange rate, so it becomes a problem. Second, it's mandated by law to pay with rubles. So you have to exchange your dollars to another currency in order to be able to sort of carry your economic activities in that jurisdiction. So think about blockchains the same way. It's a space, it's a place in the hyperspace where the only accepted token or accepted currency is the token of that blockchain platform. And if you are in need of using that platform for one thing or another, then you have to do the exchange. Whatever currency you're coming from, you just come in and buy that token. You do your business, and then if you want to take out the value out of the system, you exchange it back. And as I was saying, as the number of utilities and dApps grows in a ecosystem like that, as it grows in prominence and economic activity, as it eats the world, its value will grow. There is also a question of transaction costs, right? So if you keep the transaction costs low, right? And if you have a system like in Cardano where you could by vote change those transaction costs, in other words, they are fixed. They're not volatile. It's actually very good for developers if they want to, build something. At least on ADA level, on the level of the native token, they're fixed. It doesn't go up significantly. If, let's say, ADA goes to $10 or $100, there's a way to bring down the transaction costs so that there's always an incentive for developers to come in and build. So that's something that's decided. You need a third sort of layer of governance to actually make those decisions on the chain. So that's why, governance is very important in that respect. The notion that cryptocurrencies are not safe because exchanges get hacked is not accurate, in the sense that technically, when you are buying cryptocurrency or digital assets and you are holding it on an exchange, you are not holding it directly on the chain. And the part that gets hacked, I'm most sure is the part that is hot on the servers of the exchange, and it's there to provide liquidity and give the users of exchange immediate liquidity. And the fact that they get hacked has to do actually with centralization. It's a honeypot for hackers. And the server client architecture that enables that kind of exploits. So cryptocurrencies themselves are hack proof. The only difficulty is that to store them securely, you need to be tech savvy a little bit. You need to know what the seeds are. You need to know how to operate your cold storage. And things have gotten a lot better than they have been in 2 or 3 years ago. But still, there is a lot of sort of an experience gap that this whole industry needs to overcome in order to make it as seamless as, let's say, opening your app and sending money or receiving money, or using your credit card for that matter. There's one thing that people do not understand, is that the architecture that we use right now for digital dollars, let's say, has a lot of costs baked into it. When you swipe your card, those 2 or 3% that you pay to Visa and whoever, some part of it goes into insurance companies, to ensure that the fraud that takes place yearly on these networks is covered, and you indirectly pay for it by using these networks. Now, those kind of things don't exist in crypto, and they don't need to exist, because unless you completely give up your private keys, then you don't run the risk of getting defrauded or whatnot, or somebody using your wallet in nefarious ways. So they are extremely secure in that regard. But again, it's a different thing than exchanges being hacked, because exchanges are not directly holding your funds in a cold wallet that is tamper-proof or whatnot. Even if they are holding it in a cold wallet, let's say if 2 or 3 people know the seeds, and one of them decides that the crime of taking that money and disappearing actually makes him a millionaire, and he could just go to Belize and spend the rest of his life there and not even have to worry about anything. Maybe those guys will think about that, So those are the subtleties that many people may not necessarily pick up. I mean, from an outsider's point of view, it looks like, I bought a crypto and it got hacked and now I don't have a crypto, right? It looks like cryptos are not safe, right? Because if that were to happen in a traditional financing situation, let's say that, I took my money, I look at my statement, let's say in May, and I realize that somebody spent a lot of money on my card. It's kind of a hack. But the difference is that you just call your bank and they just write it off because, they own the chain. It's not, it is reversible, and it's also covered by insurance. So you as a consumer pay for it at the end of the day. Whereas that isn't necessarily the case in crypto, especially in centralized exchanges where you don't have the custody or the security of the asset with you. Because it's there under somebody else's custody, and it's as good as their security practices. Here's the thing: when it comes to staking with third generation cryptocurrencies like Cardano, all that matters is where are your private keys. If they are in a cold wallet, they're safe. And the beauty of the third generation cryptocurrencies like Cardano is that they allow you to stake from cold wallets, meaning that the keys are never exposed to a hot environment where, and by hot environment, we mean a computer that's connected to internet that could be potentially compromised. And if somebody gets a hold of your seeds, then, the seed words, and then your wallet is basically hacked. So by staking from a cold wallet, you are absolutely guaranteed to the tune of 2 to the power of 256, which is a ginormous number. It's so ginormous that, the most powerful computers in the world will spend 10,000 years in order to crack the code. It's impossible at this point to crack it's impractical, they say, to just repeat the jargon verbatim. But if you are staking with a cold wallet in a Daedalus, for instance, which is the wallet in Cardano, in the Cardano ecosystem, then your funds are safe unless you give your cold wallet to somebody and you tell them the PIN. You are completely safe, and that's different than staking on an exchange, because unless the exchange has the same sort of rules and puts everything in a cold wallet, then you run a risk of your funds being stolen. Now, exchanges also have insurance these days, although I believe that insurance is very expensive to obtain. But you still run a risk of losing your funds because these exchange hacks actually happen all the time. And you can calculate your risk-adjusted returns if you're staking on an exchange, and my sense is that it would be negative. The misconception that the low transaction per second means that you will never be able to use it in the setting that the current finance infrastructure works stems from the fact that in order to be able to use the money, to use a system as money, you have to be able to produce, to have the same throughput as Visa, which the latest estimates show that the Visa network, at least on their website, it shows that the throughput capacity for them is 56,000 transactions per second. Now, when that happens, when people talk about that, they fail to recognize the speed at which the digital asset or crypto space is it reinventing itself. There are new protocols. Proof of stake, for instance, is a new protocol that allows and does away with the computational complexity that proof of work has in the case of Bitcoin and Ethereum. And in the early simulations and early estimates basically show that this type of protocol is fully capable of matching, even exceeding the throughput of Visa at the current form. So when they talk about transactions per second, when they say that you cannot use it as money because of the fact that there's a limit, there might be some truth to that in terms of looking at technology backend and saying that proof of work doesn't produce that much transactions per second in its basic form. But it completely ignores the fact that there are other protocols that are fully capable of matching those speeds and throughput. There's this misconception that the digital assets do not have intrinsic value. And that stems from the fact that they are not backed by cash flows. And I think that's a wrong way of looking at these digital assets, because they represent a completely new way of capturing, generating and capturing a value. And if you think about them in terms of their network, the worth of the network and what the network is providing in terms of utility, you will see quickly that the digital assets have value the way that the medallions, the taxi medallions had value back in the day. Because especially in proof of stake networks, right? Proof of stake basically allows you to participate in the proof of stake tokens, allow you to participate in the network by buying these tokens. So the token is your price of admission. You come into the network and you can reap the benefits of whatever that token represents in terms of economic value. So networks themselves produce economic value through their smart contracts, through the fact that you could store and transfer value, and through other uses that could stem from from the future uses. So if a network has a utility from derives its utility from smart contracts, and those smart contracts require this token to be used, then this token has actually value in the open market, and the value of that token becomes basically its intrinsic value, because there is a spot market for that. Even though it doesn't have cash flows attached to it, it has an economic value that is easily spotted on the market. So it has an intrinsic value in that regard, even though it doesn't derive that value directly from cash flows. It's very hard to define digital assets in terms of their classification and whether they behave like equity or debt. And I think the closest thing you can think about in terms of their analogy in traditional world is commodity. Even though they might be, in proof of stake, for instance, in Cardano, it could be a commodity backed by some form of cash flows, but still it's a commodity. If you take oil, for instance, right, you can say that oil is valuable because of the fact that it's used in different industries to produce something that is in demand. The same thing can go for digital assets. For Cardano ADA, for instance, the token, you can say that it's used as the fuel in this network that houses a bunch of business logic and smart contracts that are used in order to facilitate commerce, in order to facilitate banking, et cetera, et cetera. And as that fuel, it's valuable because that's the only token that is accepted in this universe of networks. And as the importance of the network grows by eating the world, in a sense, it goes up fast because of the fact that in the case of Cardano, it is it is fixed. The supply is fixed. And when the supply is fixed and the demand goes up, the price goes up significantly. In the case of tokens that represent something in real world, like real estate, you can say that they definitely derive their value from that real estate, as long as it's accepted as a form of representation of that real estate. And those tokens will be backed by cash flows, because if you if you rent that real estate and that real estate is bringing cash flows, and the token represents your deed, which is completely recognized by courts and everybody else, then that token has cash flows. It's attached to cash flows directly. And the same thing can be said about, equities. Equities in and of themselves is just a blip on your computer. But they are, your ownership in a company. That generates cash flows. It's kind of works the same way. The way I think about digital assets is and how they create value, especially in the proof of stake side, because it just gives so much more breadth and material to work with for financial analysts, is that they derive their ultimate value from economic activity that takes place in their networks, right? So if, let's say, Cardano has 100 smart contracts, and these smart contracts power real, they replace certain logic or certain services in the real world, then they capture that value on that smart contract. And that smart contract basically becomes, the repository of that value on this blockchain. In order to have access to that smart contract, you would have to buy ADA in order to use that contract. So all these smart contracts add to the value of this token, and with the token being traded in the open market, you can observe that value in real time. There's this misconception that blockchain is not necessary or needed for Western countries because we have already, the infrastructure to function. And that's true. It's a true statement that, that blockchain probably produces the greatest value for countries that don't have the infrastructure that we have. But there's still case to be made for blockchain to exist in Western countries, because of the fact that it's very cheap to run a blockchain, to a degree that it will decimate and completely obliterate the largest, portion of economy. And maybe that's the reason why this misconception is being perpetuated, because it poses a threat to economies, advanced economies. Because what are you going to do with all those people if the logic gets transferred to a piece of code that a multi-million-dollar company used to produce? So it's kind of an existential dilemma for developed countries. But I think in the long run, they will have to sort of restructure themselves around these new technologies. The reason why I mentioned this is that it's a disruptive technology. The blockchain is a very disruptive technology in the sense that it's fundamental, in the sense that it could be used across many different sectors, and it is very cheap in such a way that it completely, as I was saying, obliterates the need for certain companies or sectors to exist. And that is immediate. It's not like, blockchain right now isn't usable, but 10 years from now, it's going to be a problem. Usually the technology evolves in such a way that you have very crude, first iteration of technology. You have prototypes, and then the prototypes turn into first products, and those products are really clunky and expensive, and then the incumbents could basically laugh at them. If you look at history, digital cameras were really expensive in the beginning. The cell phones were really expensive in the beginning. We had pay phones, and nobody, I've seen an interview from Goldman Sachs, the head of Goldman Sachs, who said when cell phones came in, I thought it's just a fad because we have payphones on every corner. But he was wrong, because cell phones became cheaper, and the incumbents became cell phone companies. But in the beginning, the cell phones were really expensive. But what they do when the new technology comes, what it does, it gives the incumbents the time, 10 years or whatever, and they see that what the new technology is capable of, and it kind of they can calculate its trajectory and reorganize themselves. So the AT&Ts of the world in the United States, who owned a vast network of payphones, for instance, they transformed themselves into cell phone companies, right? Now, blockchain doesn't give you that luxury, because if you are a company right now, right, and you are producing your economic value by producing some service that, that could be replaced by the blockchain, and if blockchain comes in and replaces it, especially the open blockchain that is owned by no one, then both the country loses its grip on economic activity. The taxation dollars could go nowhere. The economic activity, if it moves into an open blockchain away from the jurisdiction that it existed in, it becomes an existential threat. And that creates these kind of like uneasy questions for the society. So the way I see the space developing in the future is that open blockchain, because it's open and because it's going to develop at a faster pace than anything else, because it's just it's been there in the beginning, will produce the most benefit for the developing world that do not have the resources to invest in creating their own blockchains. But countries like the United States will have their own version of the blockchain. The way I see it is that we will have a sort of government sanctioned blockchain or whatnot, where the companies could exist on top of it, and it would have to be limited to people who are living here. And in order to have access to it, you have to sort of have legal ways of accessing this blockchain. And new industries will die and new industries will spring up on top. So that's the way I kind of see the whole space developing. And in that case, in that scenario where powerful countries, the Western countries, have their own blockchain, they talk to each other, you don't necessarily have to give up the economic activity to an open blockchain, for instance. You probably will still have interoperability, but your country will still run on an sort of a version of an open blockchain for your citizens that would be on a piece of technology that is very efficient. So this concludes the episode number 3 of Slot Leader for this week. I hope you enjoyed the program, and if you like the content that we are putting out, please do not forget to subscribe, as we will have a lot of interesting concepts to be explored in depth in the coming weeks. I will see you next time.